I think what happened in precious metals was simply that the market gave us too much too quick.
Yeah.
When people say to me, well, God, the silver price is down to 80. I say, really? I thought it was up from 20.
Right.
You know? So you have to take time frame into account. Anytime you see a hyperbolic chart, what the Canadians call a hockey stick graph, you need to know that it corrects itself 99 times out of 100. And the backside of a hockey stick is just as steep as the front side was, but it's a lot less fun if you're long. It doesn't usually retrench as far as it went up because it usually goes up, but it retrenches. You, at the beginning of this call, Craig, mentioned the decade of the 1970s. Unlike some of the listeners on this call, I was there, cognizant.
Yeah.
And I recall that greatest of all gold bull markets, where the gold price went from $35 to $850. 4 times during that decade, the gold price fell by 25% or more. One time in 1975, and I remember it like it was yesterday because I was long, the gold price fell by half. So you need to understand that cyclical or volatile declines can occur within a secular bull market, and it doesn't change a damn thing.
Mm-hmm.
If you have the psychological and financial preparedness to stay the trade, this isn't even noise to you. It's a distraction. If you don't have both the psychological and the financial strength to stay the trade, this could be fatal to you.
Yeah.
Now, I'm fairly public about the fact that in the real runoff, I sold about 80% of my silver. I'm not suggesting that other people do it, and I think the reason that I did it is instructional, because it's personal. I bought silver when it was hated. I bought it when it was hated because I thought when it just ceased to be hated, even before it became popular, that there was a lot of rebound in price. I bought it too, and we've talked about this before, Craig, you may not remember, but we talked about the fact on your show that when the momentum in the precious metals trade was established by gold, as the generalist investors tiptoed into the precious metals space, that market leadership would change from gold to silver.
Mm-hmm.
When that happened, that was the key to me that silver was unhated. I own gold in my investment portfolio. I consider gold to be a savings asset. I own silver in a speculative portfolio, a very different part of my portfolio. And in my speculative portfolio, when an investment performs as expected, I don't care how high I think it can go. I just care whether on a risk-adjusted basis it's the best speculative avenue for my money. I bought the silver because I thought the price could go to 50. I was wrong. I went to 75. Well, it went higher, but I sold it at 75. And I did it because, in a sober moment, I recognized that if the silver price didn't have to go up anymore, it could, but it didn't have to. The tension on the spring had been released in the move 20 to 75. And if, as a thought experiment, silver traded sideways for a year, by definition, I'd make no more money on my silver because it traded sideways. But the silver stocks were being valued by Bay Street on a $45 price assumption. So without the silver price going up, the silver stocks could escalate on a valuation basis by up to 50%. If the silver price went up reasonably, the silver stocks would go up too. Paradoxically, if the silver price were to decline from $75 an ounce to $50 an ounce, given that the valuations were predicated on a $45 assumption, I had more shelter to the downside in the stocks than I did in the silver itself.
Yeah, that's true.
So for me, it was a good decision. I should also say I scraped some money off the table, all the way out of the table. I got out of the way of speculation, which is to say I bought physical gold with it, which is the way I save.
Right,
So I bought silver stocks, physical gold, and oil and gas stocks with the proceeds. I I got lucky in the last part of the trade.
The global commodity markets are currently experiencing violent, terrifying volatility. After staging a massive breakout, gold and silver just suffered a brutal short-term correction, causing retail investors to panic and dump their positions. But this terrifying price action isn't the end of the precious metals rally. It is exactly how a historic, secular bull market behaves. When an asset goes parabolic, the mathematical reality of market gravity guarantees a violent shakeout to punish impatient speculators.
Absolutely narrative. I think people are being stupid.
That wouldn't be the first time.
I think most people don't do any work, though.
Yeah.
People pay slavish attention to price levels. And people pay slavish attentions to stupidly short periods of time.
Yeah.
And people say that the GDX is down by 16%. No, it's not. It's up by 100.
Well, that's true.
It just depends on your time frame.
Yeah. Yeah. Where you start.
If you segregate between price and value, when I look at the major mining companies, and I do net asset value calculations, including their development pipelines and their cost of capital, at $5,200 gold, I get a markedly higher number than the enterprise value of these companies today. People say that these companies are trading at 1.2, 1.3 times NAV, but they do that based on consensus metal pricing at $3,200 or $3,300 gold.
Right. Right.
If your earnings are calculated on a $3,300 basis and you're selling your material for $5,200, it's going to be very tough not to yield a positive earnings surprise. Now, for me, I have a very full portfolio of the big guys, a very full portfolio, and I hope they go down in price so I can buy more. I am unlikely to sell my gold stocks, my big gold stocks, my really good gold stocks, even my best juniors, anytime soon. The consequence of that is, given that I'm not going to sell, I would prefer to buy. And obviously I would prefer to buy stuff that was cheaper as opposed to more expensive. I realize that many of your listeners, don't have the courage born of knowledge that I have. And many of them probably have different financial circumstances. But if you have a good enough sense of a company that what you would like to see is lower in price, then you probably know enough to invest. I think you're right. I think the oil price moved up because people were unnerved about the supply side in oil, and I think they should. Yeah. You and I have talked before the wars, plural, that we were underinvesting in sustaining capital in the oil business to the tune of about $1 billion a day. Now, I had anticipated the supply shortages would take place in 2029. Fast forward to a war.
Yeah.
And that changed, obviously, everything. It didn't change the underlying economics around the oil business. Oil supplies will get tighter, and the market will respond by price. Will these prices hold? That's a function of peace. When or if we have peace.
Yeah.
The second question revolves around the US dollar. And there the answer is trickier, and it will be very unpopular with a Canadian audience. My friend Doug Casey described the US dollar as the worst currency in the world, with the sole exception of all of the others. The US dollar, for all its fault, is the most liquid currency in the world.
Right.
And it's also the most transparent, the least opaque currency in the world. It is a currency where most of the international debt in the world is denominated, which means the demand for dollars to pay back debt, irrespective of Mr. Trump's popularity or lack thereof, is very high. No other currency has that.
Yeah.
The last time I looked, about 2.5% of the world's international obligations were denominated in renminbi. So what do you think the relative demand for debt service between renminbi and US dollars are? This one's fairly simple. As absolutely ugly as the numbers around the US dollar are, as ugly as they are, paradoxically, they're uglier in other places.
Yeah.
And when people get very concerned about their liquidity, about the sanctity of their liquidity, the global demand for U.S. dollars in the past 4 weeks has gone absolutely crazy, including by countries that already have too many of them. Now, I think this is a fairly short-term phenomenon. Let me rephrase that. I think the U.S. dollar over 10 years will do relatively well against other currencies. I think the U.S. dollar over 10 years absolutely, that is not compared to the Canadian dollar or the euro, will do extremely well. Extremely poorly. I think that the purchasing power of the U.S. dollar in isolation will fall by 75% in purchasing power, which means that a basket of goods and services that cost you $1,000 today will cost you $4,000 10 years from now.
Yeah.
I lived through that in the decade of the 70s. The purchasing power of the U.S. dollar in that decade fell by 75%. Not coincidentally, Craig, the gold price ran 26-fold.
Not coincidentally. That's right.
That isn't to suggest it's going to run 26-fold from here, but I would ask your listeners to consider the probability, I think, that gold maintains its purchasing power.
Yeah.
Which means that the nominal gold price in U.S. dollars, should mirror the decline in the purchasing power of the U.S. dollar. Arithmetic.
Right.
Maybe it isn't 4-1. Maybe it's 3. Maybe the gold price only doubles in 10 years. You get the point.
Right.
You own gold defensively. If you have the courage, you invest in gold stocks, taking the company risk around the price trend in gold. If you really have guts, you speculate on the gold side. You do it predicated on the probability of stronger nominal gold and silver prices.
The global energy market is currently sitting on a powder keg. As military conflict escalates in the Middle East, mainstream financial media is completely fixated on the daily price of oil. Retail traders are entirely missing the bigger picture. The true threat to the global economy isn't just localized conflict, it is the catastrophic vulnerability of the world's most critical shipping choke points, which hold the entire Eastern Hemisphere hostage.
You know, I've been trying myself, admittedly, the president of Kazakhstan doesn't have me on his speed dial, but I've been trying to ascertain for my own purposes what above ground inventories have been for 30 years. And I've been consistently unsuccessful.
Yeah.
I've gone to industry conferences. I've, bought bottles of wine for Itochu and the other traders. I don't know.
Well, and Rick, your old mantra is, higher prices or high prices are the cure for high prices, right?
Yep.
But this is not necessarily that direct of a process.
Well, it takes time for that to work out. It does. I've said in capital intensive industries, the cure for high prices is high prices and time.
Yeah. Right. This sounds like the higher price.
I would argue on an inflation adjusted basis that the prices that we're seeing for uranium aren't particularly high. I would also suggest for uranium and a few other substances too, platinum among them, that the utility to users is so high that demand becomes, for a time, price inelastic.
Yeah.
It turns out that at $80 a pound, fuel comprises about 5% of the operating budget of a nuclear power plant. I need to say that. Uranium's another one where I would love to see the stocks cheaper,
pullback,
opposed to more expensive, but that's not going to happen. This is going to be a good year for uranium stocks. For a couple reasons. I wasn't able to go to the World Nuclear Association meetings in London. Too busy in retirement. But I was able to listen to about 60% of the recordings, and I was struck by a couple things there. The first thing I was struck with was there was odd consensus on the dais that the global above ground finished inventories were 200 or so million pounds. I don't know how to get those numbers, so I don't know if they're true or not. But the point was made that with a supply deficit of 30 million pounds and above ground finished inventories at 200 million pounds, that we had 6 years to get through inventories before we had to catch up.
Yeah.
That completely neglected the fact that if that 200 million pound number is right, Sprott owns 82 million of them.
Right. Of that.
That's not available for sale.
Right.
That cuts the available for sale estimate by 45%.
40%. Yeah.
That becomes salient. The second thing that I noticed, and I'd seen this myself, was that for 15 years, the utilities had availed themselves of the spot market for material because it was cheap and it was liquid. But the spot market isn't liquid anymore. Most days that I look, the Sprott Physical Uranium Trust trades between 2 and 4 times the dollar volume of the spot market, which is to say the spot market has become the spot market. The companies that have relied on the spot market for product can't rely on it anymore. And that's come to be reflected in the term market. In the term market, near-term delivery, 2026 delivery is as much as $8 a pound higher than the spot market. What that means is that the utilities have become concerned enough about supply that they are willing to pay more in the near term to lock in their supplies in the long term.
Yeah.
And this is extremely bullish.
Yeah.
Extremely bullish. The third thing that's bullish, you and I have talked about in the past, but for the benefit of those few listeners on today's calls that haven't slavishly listened to our prior conversation.
Yeah.
The structure of the uranium market is changing from the spot to the term market, unlike any other commodity in the world. The significance of that is that uranium producers know with some certainty, provided that they have a credit grade counterparty, a utility, not a trader, what they're going to receive for their product and how much they can sell. And that means that doing cash flow forecasting, whether you're a provider of equity or a provider of debt, is much more certain. And this will lower the cost of capital to the uranium sector, and it will increase the availability of this sector. Let's look at Lee Currier at NextGen. There's no way in the world that Lee, with his balance sheet, albeit a good but small balance sheet, could independently, on balance sheet, finance the construction of their Saskatchewan project. Arguably the best undeveloped uranium project in the world. It's just too big, and they're too small. But if Lee can go to Ontario Power, Duke Power, Southern Companies, Tokyo Electric Power, China General Nuclear, a bunch of investment-grade counterparties with contracts, and then take those contracts to the bank, particularly if he can do a turnkey build on that project, fixed price turnkey build with Westinghouse Cameco, a project that he couldn't finance before on his balance sheet becomes financeable. It doesn't mean that he will do it. It just means that if Cameco comes into him, or Anglo-Tech comes into him, or BHP comes into him and says, you should sell us this because you can't build it, he can say, well, you might be able to buy it, but I can build it. So your price better reflect the fact that I can build it. And that's a huge, huge, huge change. The NextGens of the world, the Paladins of the world, the Yellow Cakes of the world, will be able to build their projects if they choose to, because the migration of the market from volatile spot to fixed price long-term contracts suddenly makes these things much more financially viable.
You've got me thinking price maker versus price taker in that.
That
situation.
might be aggressive, but there's zero doubt we're seeing in the market now, and this is actually a related topic. I probably told your audience more than they want to know about uranium. But if somebody goes out to build a nuclear power plant today, a big one, I'm not talking about one of these little firecracker,
right.
Wrong phrase, SMRs, the banks, which are putting up 60 or 70% of the construction costs, are increasingly requiring the builder to obtain enough uranium over time to amortize the loan, which is to say they are requiring China General Nuclear, as an example, to obtain 20 years of supply to amortize the loan. The availability of that in the contract market is what is really driving the availability of the producers to secure these type of agreements. It isn't just the producers that need these contracts. The consumers need the contracts too.